Is this the time that we should be feeling even more bullish? Does the momentum continue? Or should investors be using this opportunity to gradually perhaps raise cash, a rainy day fund, or a war chest for other opportunities down the line?
Yeah, thanks, Tom. And a few things there. One, when you look historically at how markets perform, typically what you see is that in a late cycle environment, markets can do quite well. And we've done some analysis looking at the last 4 Fed cycles, for example. On average, the S&P was up 9% during the cycle, and in fact, up another 16% the year after the cycle ended. So typically what that has told you is that markets tend to perform well until you get up to that recessionary period. So it's usually the 1 to 6 month period prior to entering a recession where you start seeing a sell-off. And you usually don't get bear markets until you're in a recession or just entering a recession. Now, given the strength of the U.S. economy right now, we are far away from any sort of recessionary environment. And so we continue to feel that equity markets have room to run here, albeit higher volatility and maybe some sector rotation as well.
So what does that rotation look like? I mean, what could it tell us? What kinds of sectors would we want to see outperform to tell us that things could be turning?
Sure. So, this year, obviously, we've seen tremendous performance by technology and discretionary. Over the last few weeks or so, since the Facebook earnings, for example, we've seen a little bit of a pause in technology and discretionary. We've seen some new leadership emerge. We've seen industrials, healthcare, staples, all kind of come to the forefront here. As you get later and later cycle, things like healthcare and staples are very defensive. We don't know if there's a need to rotate into those to a large extent right now, but we do see a need for investors to diversify here. Start complementing your technology portfolio with some of those consumers, staples, healthcare. I think that's the right positioning right now.
I also think about financials. I think about the yield curve. We mentioned before that the 10-year note yield is moving lower, just as the 2-year note yield is moving higher. That's been a trend, the flattening of that yield curve.
Yeah.
Is it important? I've heard the arguments. Some people say that the yield curve flattening certainly tells us that things are perhaps getting towards that recessionary phase. Others say it doesn't matter as much anymore because of all the central bank intervention that we've seen over the last 10 years. Is it important to watch the yield curve for a sign that the recession is coming some point down the line?
Yeah, I mean, certainly historically, the yield curve inverting has been a recession indicator. And in fact, if you look at the analysis there, after the yield curve inverts, on average, the recession occurs 6 to 18 months after inversion. So once the yield curve inverts, we're still not looking at an immediate recessionary environment by any means. And, to your point, is this time different? Well, it's always hard to say that, but to some extent, we have been in a tremendously low rate environment for nearly 10 years now. So maybe, a 25 basis point, 10-year, 2-year is equivalent to something like what 100 basis points used to be. So, not to say this time is different, but we do have different dynamics in place. We're certainly not seeing recessionary environment on the horizon, and we still have some time even if the yield curve inverts.
We know that tactically investors are making their nuanced moves between sectors here and there on a day-to-day, week-to-week basis. From a strategy standpoint, because that's what you do, how should portfolio allocations look for U.S. investors? Where are the overweights, where are the underweights, and where should people be a little bit more neutral on things right now?
Yeah. So we continue, globally to see strength in the U.S. We think there has been a clear divergence economically, and so that's been playing out in the marketplace as well. So we continue to remain overweight the U.S. We continue to see the dollar having some strength here. We think in the second half of the year, we think that story will continue. And out of that falls, probably some more volatility and uncertainty around EM, and probably more certainty around that small cap story we've seen done so well this year. So we think, within your portfolio, overweight U.S., perhaps overweight small caps. Within sectors, we continue to like the technology winners from disruption longer term, but we would round that out, like we said, with some industrials, healthcare, and staples. So that's kind of what we're looking at right now.